Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Senseonics Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, so I think we have to start this one with the growth numbers. I mean, they're genuinely exceptional.
Oh, absolutely. This really sets the stage for what Senseonics is, a high-growth medtech innovator.
So what are we talking about specifically?
But look at the preliminary numbers for Q3 2025. Unaudited, but still, they came in at $8.1 million in revenue.
Which is a pretty sharp increase.
A very sharp increase. But here's the kicker for anyone looking long-term. The analyst models. They're projecting annualized revenue growth between 63 and maybe 72%.
All the way through 2027.
Through 2027, we are talking about a company that could triple its revenue base in just a few years.
That kind of growth it's rare. And it's all tied to one product, right? The SENS continuous glucose monitoring system.
That's the one.
But, this is a crowded market. You have giants like Dexcom, Abbott. So what is the actual moat here? What makes SENS so special?
It's pure product differentiation. They've basically carved out a category that no one else has really conquered yet.
Okay.
SENS is the only long-term, fully implantable CGM system that's approved in the US and the EU.
And that word implantable, that's the whole story.
That's everything. The sensor lasts up to 6 months.
6 months?
Yeah. I mean, just think about the convenience for a patient. You go from changing a sensor patch every week or two to dealing with it just twice a year.
That's a massive quality of life improvement, a huge one. But I have to push back a little here. If it's such a game changer, why aren't they just, running away with the entire market?
That's a critical question, and the counter argument is the procedure. So while the sensor lasts 6 months, it does require a minor in-office surgical procedure to insert it and then to remove it. It's not a simple peel and stick patch.
I see. So there's a trade-off. Incredible convenience for 6 months, but a higher barrier to entry to get started.
Exactly. That's the central tension in their business model. And it's probably why they made that commercial partnership with Ascensia Diabetes Care.
Right, to handle distribution.
Ascensia is doing all the heavy lifting on sales, marketing, global distribution. It lets Senseonics just focus on the R&D and manufacturing. It's a smart move.
Okay, let's pivot from the product to the cold, hard numbers. High growth almost always means high cash burn. Are they profitable?
Oh, no. Not even close. They are absolutely still incurring net losses, but that's pretty typical for a company at this stage.
So you're prioritizing growth and market share over profit.
Exactly. But the path to profitability, it's getting a lot clearer. You can see it in the margins.
What are they looking like?
The gross profit for the first half of 2025 was significantly better than the year before. That's huge. It means the unit economics are working. As they sell more, they get more efficient.
And if that trend holds...
What the analyst consensus is for break-even, or maybe even positive earnings per share by 2027.
So a 3-year runway to profitability. Do they have the cash to make it there?
They seem to. As of Q2 2025, the balance sheet showed $84.6 million in cash and cash equivalents. For a company this size, that's a pretty good cushion.
It gives them breathing room.
A lot of it, which is important because they're going to need it to navigate this other major hurdle.
Okay, let's get into it. This is the big risk that's been dominating the conversation, right? The delisting.
Yes. This is the one that every investor or potential investor really needs to understand.
So what happened exactly?
On November 10th, Senseonics filed a Form 25 with the SEC.
Okay, a Form 25. For those of us who don't follow SEC filings daily, what is that?
It's basically a formal notice that they're removing their shares from listing on an exchange. In this case, they voluntarily chose to delist from the NYSE American.
Hold on, voluntarily. Why on earth would a company with such a strong product story choose to do that?
It often boils down to cost and compliance. Staying listed on a major exchange is expensive. There are standards you have to meet, administrative costs.
So they're cutting costs.
Right.
But what are the consequences for shareholders? It sounds bad.
It can be. The stock doesn't just vanish. It usually moves to trade on the over-the-counter or OTC markets.
And the main problem there is liquidity, right? It's just harder to buy and sell.
It's much harder. But the bigger problem really is the institutional money.
Explain that.
Many large funds, pension funds, mutual funds, ETFs, they have rules in their charters. Mandates that forbid them from holding stocks that aren't on a major national exchange.
So if a stock gets delisted,
They are forced to sell. Doesn't matter if they love the company, love the 6-month sensor, love the growth story. If it's not on the NYSE or Nasdaq queue, they have to dump their position.
Wow. So the delisting can trigger this massive forced selling pressure that has nothing to do with the company's actual performance.
That is exactly the risk. It's not an operational risk, it's a structural one.
Okay. So with that huge cloud hanging over them, what are the charts telling us? Is there any investor confidence left?
Actually, yes, and it's pretty surprising. Since late Q2 2025, we've seen a very constructive bullish trend develop.
What does that look like?
The shares bounced hard off their 52-week low of about $5, and now they're trading near $6.59. We're seeing a pattern of higher lows and higher highs.
Meaning buyers are stepping in sooner each time it dips.
Yep. The demand is building, and the technical signals back that up. The stock is trading above both its 50-day and its 200-day moving averages.
It's a classic bullish confirmation.
It is, but maybe more telling than the charts is the insider activity.
Oh, the C-suite. Are they buying or selling?
They're buying. Filings show both the CEO and the CFO made open market purchases in August and October.
So the people who know the most are putting their own money on the line. That's a powerful signal, especially with the delisting uncertainty.
A very powerful signal.
Okay, so let's try to tie this all together. What are the big events, the catalysts, that investors should be watching over the next, say, 3 to 4 months?
The first one is coming up soon. The Q4 2025 earnings release. That's expected around February 6th, 2026.
And everyone will be looking for continued revenue growth and shrinking losses.
Exactly. A strong beat there could really change the narrative, regardless of where the stock is trading.
And the second catalyst is about the product pipeline.
Yes. We're waiting on news for the next generation sensor approval, both in the EU and the US. That's anticipated for Q1 2026. That's the future revenue driver right there.
Right. And what about the market chatter, the speculation? What's the ultimate upside case people are whispering about?
Well, there's a lot of buzz around them fixing this liquidity issue. There are rumors they might try to relist on another exchange, maybe the Nasdaq queue, which could solve that institutional selling problem overnight.
And what about market access?
That's the other big one. Chatter about ongoing talks with major U.S. managed care payers. If they land a big reimbursement contract, it just blows the doors off their addressable market.
And then there's the ultimate speculation, acquisition.
Always. I mean, you have a company with unique proprietary tech and a proven growth curve. It's a very attractive target for a larger player like Medtronic or, heck, even Dexcom.
So that's what's propping up that incredible analyst price target.
It has to be. The average 12-month target is sitting at $25.58.
$25. That implies, what, over 300% upside potential?
If they execute perfectly and, crucially, solve these corporate risks.
So what does this all mean for you? Senseonics Holdings really presents a fascinating dichotomy. You have, on one hand, a company with arguably one of the most disruptive, high-growth products in its space.
Validated by stellar revenue growth.
Right. And on the other hand, it's facing this critical, self-inflicted structural challenge with its corporate listing. The whole investment thesis really hinges on whether management can navigate that delisting mess and capitalize on the momentum from Q4 earnings and that new sensor approval. For the risk-tolerant investor, it's a real deep dive into whether breakthrough product innovation can ultimately triumph over complex market structure.